Good morning. I have already covered long call butterfly and already told butterfly strategy. So we are going ahead with short call butterfly. This is a good strategy in options. Please subscribe video in case of not subscribe. I am trying to give you best possible knowledge and excellent strategies so you can implement that after having a paper trade. So let's go ahead. Short call butterfly. Short call butterfly is one of the volatile strategy employed in a high volatile stock. It is usually involved selling one strike, lower strike in the money call, buying two middle strike at the money call, and selling one higher strike out the money call options of the same expiry date. Typically, the distance between each strike prices are equal for this strategy. Short call butterfly, how we can form a short call butterfly? So short call butterfly equal to 1 ITM call plus 2 ATM long call plus 1 OTM short call, or there is another option, 1 lower strike bear call spread plus 1 higher strike bull call spread, or long straddle with net credit received when trade is entered but with craft rewarded. So what is risk and reward? So maximum risk in short call butterfly limited to the difference in adjacent strike less net premium collected. Maximum reward limited to net premium collected when the underlying stock outside the range of strike price at expiry date. Break even, upper break even equal to higher strike price less net premium collected. Downside break even equal to lower strike at net premium collected. Net position, this is typically a net credit trade as you collecting more premium from the call option sold. So let's go ahead. What are the advantages and disadvantages? So what are the advantage of short call butterfly? Short call butterfly collects premium for volatility trade with no capital outlay, make profit from extremely volatile stocks without having to determine the direction. Limited risk exposure with the underlying stock is the middle strike price on the expiration date. What are the disadvantages? Usually offer a smaller return capital to straddle or strangle strategy with only slightly lower risk exposure. Significant movement of the stock and option prices is required for this strategy be too profitable. These two are disadvantages. Exiting the trade. How we can exit the trade? Offset the position by buying back the call option that you sold and selling the options that you have bought in the first place. As the underlying stock fluctuate up and down, advanced option trader may choose to untravel to spread leg by leg. In this way, trader will leave one leg of the spread exposed while his profit from the closure of other legs. So this is the example of short call butterfly. So you see strike price in x axis, then profit is in y axis at the top, and there is a zero line, and loss is there. What are the characteristic of short call butterfly is limited loss, limited profit, short in 1 in the money call, long 2 at the money call, short 1 out the money call. So this is the diagram. So we will go ahead with the example. So I will use this as an example. So you see that short call butterfly example. This is the x axis and y axis, profit loss is there, then 0, 100, 200, and below is the minus, and you see this is the maximum upside or downside gain 90, and downside is equal to b equal to 35, break even upside is 44, and there are some numbers, and maximum loss equal to 410 rupees, and maximum upside downside gain equal to 90 rupees. So this I am telling because these will be used, so you have to correlate this diagram with the example. Just see. So I am going ahead. Assumption, you have to assume XYZ is trading at 40.50 March on March 20 X1. The verdict of legal lawsuit against the company is expected to be made soon. You are expecting the price of XYZ soar up or plummet down once verdict is out. You would like to profit from the volatility of this stock without any capital outlay. In this case, you may consider to sell 1 July X1 rupees 35 stock call at 7.50 and buy to July 20 X1 40 strike call as rupees 4.5 and sell 1 July 20 X1 rupees 45 call at 0.40 to profit from the volatile outlook of the stock. Note, commissions are not taken in the account for the calculation. So this is the numbers I have used this at the 40.50. So detailed calculation, how we can calculate the maximum risk. Maximum risk equal to limited to different in the adjacent strike price minus net premium collected equal to 5 minus rupees 0.90 multiplied by 100 equal to 410. Maximum reward equal to net premium paid equal to premium collected less premium paid equal to rupees 7.50 minus 4.50 minus 4.50 plus 2.40 multiplied by 100 equal to 100. Higher then upside break even equal to higher strike price less net premium collected equal to 45 minus 0.90 equal to 44.10. Downside break even equal to lower strike price at net premium collected equal to rupees 35 plus rupees 0.90 equal to 35.90. So you see, this has been shown how this price in between and how we are getting profit and loss. So you can correlate with the diagram, and it is given has been price, then value expiration, loss from the spread, net premium collected, and spread profit loss. So this is the example. So short call butterfly consists of three equal space strike. It gets name from the shape of the profit and loss graph at the expiration. You can see above, the two outside strikes are commonly referred to as being, where the two middle strikes are commonly referred to as the body. It is a four-leg spread option strategy consisting of all calls, and is the opposite of long call butterfly, which is a sideways strategy. Before you executed short call butterfly strategy, you must find determined at which price the underlying stock will most probably not trading at the expiry date. This will be the strike price middle, where you will purchase the two options. Next, sell a lower strike price option and with a higher strike options with equal distance from the middle strike purchase. Typically, when you short a butterfly, you will receive a credit from the trade. This will your maximum profit at the expiry when the underlying stock close below the lower strike or above the higher strike. The maximum loss will occur when the underlying stock close at the middle strike price expiry. Time decay is generally harmful to this strategy, as you need to allot movement in the underlying stock for the trade to be profitable. Once it is in profitable position, time decay will be helpful. Therefore, it is preferably to use option strategy with at least 3 months left to expiry. So as you give yourself more time to be right, this is a special comment you must consider on this. So friends, I have let me review this again. I told you shortcut butterfly, how it can form. You can go ahead with first option. one ITM short call, two ATM long call plus one OTM short call. Then how risk and reward, how you can calculate maximum risk, maximum reward, break even, net position, then risk and reward, what are the advantages and disadvantages, where you have to exit the trade, then the diagram, then the example, it has been shown how to calculate. Then the profit, then this is the example, then there are some special comments where you have to enter, what you have to try, this has been shown. So friends, this is from my end. I covered long call and short call butterfly. You can this strategy. I again say the option is just like a water. You cannot catch water in your hand. And then again the second largest comment. Do not think by single selling call and put is a strategy. This is not a good strategy. Please do not do. This is a warning and special advice from you. These are the basic option payoffs. On combination of those strategies are formed. So always option is used for hedging. You use option for the hedging, that will be more profitable for you. And you take a call from them, the people who are NSE certified and they are NSE expert in options. Do not take advice from anyone who is giving you a call in Nifty, and don't accept that. You just go inquire his competence, ask his NSE certificate number, and the matter is whether it exists or not exist. Because in NSE you have to pass the exam every 5 years or 3 years, because you are not updated from the new process or new updates. So in stock market, everyone must be get a update, and he must update with current knowledge. Basic knowledge doesn't work. So always ask NSE certificate number, and always have a paper trade. So this is from my end, friend, and I shared your mail ID, mobile number, WhatsApp number. You can contact me for any clarification required this. So I am available. You can call between 5 p.m. to 7 p.m. So this is from my end, friends. Thank you. Good night.